The 30-year Treasury yield just hit the highest level since 2007. And if you're thinking, cool, who cares? Well, you're not alone. Because Treasury yields sound like the kind of thing that only matters to men in Patagonia vest, who drink $8 iced lattes and talk about risk-adjusted returns at dinner parties. But the reality is, hidden inside that number is the price of money, because that single number helps determine the borrowing cost on trillions of dollars of debt.
Imagine waking up one morning and finding out your monthly loan payment has jumped hundreds of dollars. Not because you borrowed more money, not because you missed a payment, but simply because one number, buried deep inside the financial system, quietly moved higher overnight. Now imagine that happening not to one family, but to thousands of companies across America. Businesses that employ millions of people. Businesses that make the products you buy. Businesses that keep entire towns working. Most people have never heard of this hidden problem, but it has the potential to reshape the economy over the next few years. And the warning signs are already here. Every time the economy starts making headlines, people usually focus on the same things. They watch the stock market. They watch home prices. They check gas prices. Maybe they pay attention to inflation or the latest announcement from the Federal Reserve. But almost nobody pays attention to what happens behind the scenes in the credit markets. And that's a mistake. Because long before an economic problem shows up in your neighborhood, it usually starts somewhere most people aren't looking. Think of it like a house. When you see water dripping from the ceiling, the leak didn't start that morning. It probably began weeks or even months earlier, hidden inside the walls. Financial problems work the same way. The headlines usually arrive last. The damage starts much earlier. Right now, there is a part of the financial world that's carrying trillions of dollars in loans. Most Americans have never heard of it. It doesn't get much television coverage. Your friends probably don't talk about it. Yet the decisions being made there could affect jobs, investments, retirement accounts, and even the pace of the entire economy. That market is called private credit. Don't let the name scare you. This isn't some secret club with a password. It's simply a way companies borrow money outside the traditional banking system. For years, it worked incredibly well. Money was cheap. Interest rates were low. Borrowing was easy. Companies expanded. Investors earned attractive returns. Everyone looked like a genius. Then everything changed. Inflation surged. The Federal Reserve began raising interest rates faster than it had in decades. Almost overnight, borrowing money became dramatically more expensive. For many businesses, that wasn't just an inconvenience. It completely changed the math. Imagine running a small construction company. You buy new equipment expecting to pay one monthly amount for years. Then someone tells you your financing cost has doubled, even though you haven't borrowed another dollar. Your profit shrinks overnight. Projects become harder to finish. Hiring slows down. Every decision becomes more difficult. Now replace that construction company with businesses carrying hundreds of millions or even billions of dollars in debt. That's the situation many companies are facing today. Some are managing, some are barely hanging on, and some are quietly falling behind without most people realizing it. Here's what makes this story different from the financial news you usually hear. This isn't about predicting the end of the world. Nobody knows exactly what will happen next, but understanding where pressure is building gives you an advantage. If you know where the cracks are forming, you won't be surprised if they eventually spread. So in this video, we're going to break everything down in plain English. No confusing Wall Street vocabulary. No complicated charts. Just a simple explanation of how one corner of the financial system grew into a multi-trillion-dollar market, why rising interest rates are putting it under pressure, and why everyday Americans should pay attention, even if they've never invested a single dollar. Because by the end of this video, you'll understand why many financial professionals are watching this market so closely, and why what happens there may not stay there. Before we talk about the companies under pressure today, we need to understand one simple idea. Not all loans work the same way. Most of us are familiar with loans that stay predictable. You borrow money. The lender tells you your interest rate. You sign the paperwork. From that point forward, your payment stays about the same until the loan is paid off. It doesn't matter if interest rates across the country rise or fall. Your agreement doesn't change. That's called a fixed-rate loan. Many home mortgages work this way. Many auto loans do too. You know what you'll owe each month, and you can build your budget around it. Now let's look at the other type. A floating-rate loan doesn't lock in one interest rate forever. Instead, the rate moves over time. Think of it like the price of gasoline. Some weeks it's lower, some weeks it's higher. You don't control it. You simply pay whatever the current price happens to be. A floating rate loan works in a similar way. Instead of staying fixed, the interest follows a financial benchmark that changes as market conditions change. When that benchmark climbs, your borrowing cost climbs with it. When it falls, your borrowing cost usually falls too. During periods of low interest rates, this can be a great deal. Companies save money. Investors earn steady returns. Everyone is happy. But when rates move sharply upward, the situation changes fast. Imagine renting a warehouse where the monthly rent isn't fixed. Instead, the landlord checks the market every few months and adjusts your payment. One year, you're paying $10,000 a month. The next year, it's $18,000. Your building didn't get bigger. Your business didn't borrow more money. The price simply changed. That's exactly what happened to many businesses with floating rate debt. The number driving those payments is called SOFR, short for the Secured Overnight Financing Rate. Don't worry about memorizing the name. Just think of SOFR as a financial thermometer. Every business day, it reflects the cost of borrowing money in one important part of the U.S. financial system. Banks, lenders, and large financial institutions use it as a reference point when setting interest costs on many loans. If SOFR rises, borrowing becomes more expensive. If SOFR falls, borrowing becomes cheaper. For years, this wasn't a major concern. Back in 2021 and early 2022, SOFR was extremely low. Money was inexpensive. Businesses could borrow at rates that would seem unbelievable today. Many executives assumed those conditions would last long enough to grow their companies, increase profits, and comfortably manage their debt. Then inflation accelerated. Prices for food, housing, fuel, and everyday goods climbed rapidly. To slow inflation, the Federal Reserve raised interest rates again, and again, and again. Those increases happened faster than many business leaders had expected. As a result, SOFR also moved dramatically higher. A company that had been paying a relatively low interest rate suddenly faced borrowing costs several percentage points higher. That may not sound like much, but percentages become enormous when the loans themselves are enormous. Let's use a simple example. Imagine borrowing $500 million. If your interest cost increases by just 4 percentage points, you're suddenly paying roughly $20 million more every year in interest alone. Nothing new was purchased. No expansion took place. No additional loan was taken out. The only thing that changed was the cost of carrying existing debt. Now imagine a $1 billion loan, or several billion dollars. Those extra interest expenses can quickly consume money that would otherwise go toward hiring workers, opening new locations, investing in equipment, or developing new products. Instead of building the future, companies find themselves writing larger and larger interest checks. Some businesses can absorb that pressure, others cannot. And here's the important part. This wasn't happening to just one company. It was happening across an entire lending market worth trillions of dollars. Thousands of businesses were feeling the same squeeze at nearly the same time. Some responded by cutting costs. Some delayed expansion plans. Some reduced hiring. Others quietly began searching for ways to avoid running out of cash. That brings us to the next question. Who borrowed all this money in the first place? The answer leads us into one of the fastest growing and least understood parts of modern finance. So who borrowed all this money? The answer might surprise you. It wasn't your neighbor trying to buy a house. It wasn't families loading up on credit cards. And it wasn't the giant household names you see trading on the stock market every day. Instead, much of this borrowing happened in the middle. These are companies that are already established. They have employees, customers, and real revenue. They manufacture products, provide services, operate warehouses, build software, and supply businesses across the country. Many of them are successful, but they're in an awkward position. They're often too large for a standard business loan from a local bank, yet not large enough or not structured the right way to easily raise billions of dollars through the public bond market. So they turn somewhere else. They turn to private credit. Think of private credit as a different lane on the financial highway. Instead of borrowing from a traditional bank, companies borrow from private investment firms whose main business is lending money. These lenders aren't charities. They're looking for higher returns. And because they're willing to lend to businesses that may carry more risk, they usually charge higher interest rates than a traditional bank would. For years, this arrangement worked well for both sides. Companies received the money they needed to grow. Lenders earned attractive returns. Investors poured more and more money into private credit funds because the payouts often looked better than many traditional investments. As demand grew, so did the industry. What started as a relatively small corner of finance after the 2008 financial crisis expanded year after year. Today, the market is measured in trillions of dollars. That's an incredible amount of money flowing outside the traditional banking system. But here's where things became risky. Many of these loans weren't fixed-rate loans. They were floating-rate loans. At first, nobody seemed worried. Interest rates had remained low for years. Businesses assumed borrowing costs would stay manageable. Lenders believed the companies could comfortably make their payments. Investors enjoyed the steady income. Everything appeared to be working exactly as planned. Then interest rates changed. Imagine owning a neighborhood restaurant. Business is doing well. Customers keep coming. You decide to renovate the dining room and open a second location. To make that happen, you borrow money. At first, the monthly interest bill is manageable. Your profits easily cover it. But over the next 2 years, that payment keeps climbing. Not because you borrowed more. Not because you spent recklessly. Simply because your loan was tied to a rate that kept moving higher. Now you're forced to make difficult decisions. Should you cancel renovation plans? Reduce employee hours? Delay replacing old kitchen equipment? Raise menu prices and risk losing customers? Those are painful choices. Now imagine making those decisions while your loan isn't a few $100,000, but several hundred million. That's the reality some companies are facing today. In fact, many businesses that borrowed during the era of cheap money built their long-term plans around interest costs that no longer exist. Their business models made sense when borrowing was inexpensive. But once financing costs surged, those same plans suddenly looked much less profitable. Some companies adapted quickly. They cut unnecessary spending, sold non-essential assets, found new ways to increase revenue. Others weren't so fortunate. Their profits couldn't keep up with the rising cost of debt. Every quarter became more difficult than the last. And while the public was focused on stock prices, inflation reports, and the latest technology headlines, pressure quietly continued building beneath the surface. That's why experienced investors often pay close attention to the credit market. Credit problems tend to appear before larger economic problems. When businesses begin struggling to service their debt, it's often an early signal that tougher times may be ahead. But even then, many people still didn't realize how much stress was building. Why? Because on paper, everything still looked surprisingly healthy. Loan portfolios appeared stable. Many funds continued reporting solid returns. Investors kept receiving income. From the outside, it seemed like the system was holding together just fine. But appearances can be misleading. Behind the scenes, lenders had started using a strategy that allowed struggling borrowers to postpone today's problems until tomorrow. It didn't erase the debt. It didn't reduce the interest. It simply delayed the moment when reality would finally catch up. And that strategy is one of the most misunderstood practices in modern finance. Now we arrive at the part of the story that catches many people off guard. Because if so many companies are under pressure, why haven't we seen a wave of dramatic headlines? Why do some investment reports still make everything sound relatively stable? Part of the answer lies in a practice called payment in kind, often shortened to PIK. The name sounds technical, but the idea is actually simple. Let's forget finance for a moment. Imagine you lend your friend $10,000 to help him start a small business. The agreement is straightforward. Every month, he pays you interest in cash. Everything is fine for a while. Then business slows down. One month he calls and says, "I don't have enough cash right now. Can I skip this month's interest payment?" Normally, that would be a warning sign. If someone can't make their payments, you naturally become concerned. But now imagine you answer like this: "Don't worry about paying me today. I'll just add this month's interest to the amount you already owe." No cash changes hands. Instead of paying you, your friend simply owes you even more money than before. That's essentially how a PIK arrangement works. The interest doesn't disappear. It gets added to the loan balance. Next month, the borrower may even owe interest on that larger balance. Imagine your friend still hasn't handed you any cash. Yet you tell your family, "Good news! I earned another $1,000 this year from my loan." Someone might ask, "Did he actually pay you?" And you reply, "Well, not exactly. He just owes me more now." Up to this point, we've talked about rising interest rates, floating rate loans, private credit, and the ways some companies have tried to buy themselves more time. But eventually, time runs out. Every loan has an ending. Think of it like a balloon payment on a car or a mortgage that's due on a certain date. You can't keep extending it forever. Sooner or later, you have to make a decision. Pay it off, sell something to raise the money, or borrow again under whatever conditions exist at that time. In the private credit market, many loans made during the years of ultra-low interest rates are approaching that moment. Financial professionals often call this the maturity wall. It's not a physical wall, it's a timeline. Over the next several years, a large number of loans will reach the point where companies must refinance or repay them. And that's where today's higher interest rates become impossible to ignore. If this video helped you understand a part of the economy that rarely makes the evening news, share it with someone who enjoys learning how money really works.